as those interest rates go up and as these banks maybe were talking about long-term, holding their funds for long-term, their rate of returns that they were getting on their money wasn't what the consumers were demanding for a rate of return based on the Fed interest rate.
Gotcha.
So right now we have some CDs or money market accounts that are 4.35%, right? The rate of return on those monies. But if the bank has their money locked up at a lower interest rate, they're paying more out than they're actually getting back on their money at the moment.
We want to go over just some different market information from a perspective, talking about like the lending world, and not so much the mortgage world, but the banking world, the where money moves around and how things move around. And we're getting the question a lot right now. Banks have hit the headlines again with failures, with other things that are going on. But most of us, we hear it, and I guess here today we're going to try to bring a little bit more reality to it, or give a little bit more context to what's going on. Some good, some bad, but either way it will be informational.
Right.
I'm here with Dan Doyle today, with Nations Lending, Chris Martin coming to you, and we just want to go over banking.
Yeah, sounds good.
So, banking, what has happened in the last couple weeks? What's in the headlines that everybody is
right, that everybody's seeing versus whether it's reality or not, and what it looks like. So I'll try to give as condensed a version as possible rather than just kind of the highlights and go from there. So unfortunately, some of the banks previously, as banks lend out money, they have to keep a certain amount of liquidity in their books, right, to be able to manage and be able to keep all of those loans and everything they have afloat.
So when you say liquidity, you mean cash?
I mean cash.
Deposits.
Reserves.
Our
Deposits,
money.
right, correct.
Our savings accounts, our checking accounts.
Correct, or access lines of credit, right? Access to credit, right, also counts into that. So what had happened with SVB directly, so Silicon Valley Bank, the one that, they were actually...
kicked all this off.
They were actually the second bank, and that's what people don't realize.
Oh, really?
So Silvergate Bank was first, and then SVB was number 2. And so what happened is SVB, knowing that they weren't meeting their liquidity requirements or their cash requirements for what they needed, they tried to go and round up $2.25 billion on the streets, which then everybody kind of started taking notice of that they were trying to get cash and capital, another, $2.25 billion. But to come up with that liquidity, unfortunately, they sold treasuries for less money that was, that they could get for them if they just held them long term and the government was going to pay back the money for the treasuries. They sold them prematurely, which then they got less money for them that they could if they held them long term because they needed those funds. And that's what then kind of set everything in the domino.
So to put that in perspective, how big was Silicon Valley Bank?
60 billion, I think, was
60
there.
billion?
Right, yeah, so correct. I think with their reserves and everything that they had. So by the time everybody did the run on the bank, they were about $1.92 billion short for everybody doing a run on the bank. Henceforth, they were trying to get that liquidity of the $2.25 billion.
Because there was like a time frame where some absurd number of billions of dollars got withdrawn from that bank.
Correct.
Precipitated.
It was almost 40 billion at one go.
Yeah, 37.
Right. Yeah, it was just shy of 40 billion all in one go that was removed, which then caused them to stop and pause withdrawals, which then that sends everybody else into panic. Right. When you can't go withdraw your money, you're going to text everybody that has money at that bank, letting them know that they can't withdraw their money, and then it creates that run, that old terminology, the run on the bank.
Gotcha.
So then the next one that was in line was a bank called First Republic Bank, where First Republic Bank, the reason they got brought into headlines, it was more of, hey, here's, what the banking landscape looks like. And as far as deposits versus what they had on cash assets versus what was lent out, First Republic Bank was at like 68%, right? Which is better than the normal, better than the average. But a New York Post article put them in the headlines saying, if you take a look at the percentage of liquidity versus loans out at First Republic Bank, using them as an example, but they got then thrown in the mix. So they were actually one of the most. So that the reason that became such a big issue is that once First Republic Bank fell, the rest of the regional banks were going with them.
Gotcha.
So they were the biggest one of the regional banks, and so that's why they were under so much scrutiny, because if they went, then everybody went underneath them. And if you take a look, there was $30 billion that was influxed by JP Morgan Chase, New York Bank Mellon, and Citigroup, a lot of other banks. actually, to fortify First Republic Bank, they put their own $30 billion into that to capitalize them, just to keep them going, because they knew how important that was and the rest of the dominoes that potentially could fall.
Wow.
Yeah, so I mean, they kind of
So
helped
the banking
their own.
industry was kind of trying to prop itself up.
Correct.
We don't need to be in the headlines any more than we already are.
Correct.
Let's stop this.
Right, and so literally $30 billion deal went into them.
So what is causing, if we back up to, let's, I guess, talk about Silicon Valley, since they're the
right.
first ones that hit the headline. What caused them to start to get into trouble? Like, I know the deposits requirement,
Right.
but there's something precipitated that, because they were moving along at a good clip. Like, is this an interest rate related
It is
challenge?
an interest rate related. So as those interest rates go up, and as these banks maybe were talking about long term, holding their funds for long term, their rate of returns that they were getting on their money wasn't what the consumers were demanding for a rate of return based on the Fed interest rate.
Gotcha.
So right now we have some CDs or money market accounts that are 4.35%, right? The rate of return on those monies. But if the bank has their money locked up at a lower interest rate, they're paying more out than they're actually getting back on their money at the moment, right? So if everybody has mortgages for 3%.
So in simple terms, their income stream from the assets they have out from the last few years is producing a small amount.
Correct.
And now with rates up, they have to pay a much greater amount. So it's flipped them backwards.
Correct. Yeah, it's a losing proposition to them.
Gotcha.
But banks, to keep the liquidity for clients, so let's say a regional bank, for example, has somebody with $100 million, which is very common in regional banks, then at that point, what happens is this bank will give them another 0.5% more on their money to get them or woo them over, because the bank that is doing economically what is the right thing to do and giving them a good rate of return based on the cash that they have, the other banks were willing to kind of stretch that a little bit. So as everybody was stretching, right, you're 1.5% higher than the rate of return you're getting, and that's just not sustainable.
Gotcha.
When you're looking at a payout basis.
Okay.
Not only that, they were banking on the economy and long-term rates. But what happens is, if Jerome Powell and the Fed is raising the rate continually, nobody wants to buy back those treasuries at a lower yield when they know that the rate's going to be up again in 2.5, 3 weeks.
Gotcha. So do you suspect that this is putting a lot of pressure on the Fed right now to stop raising rates, or do you think it's not going to have any impact?
So I had just heard recently that the Fed is planning on kind of seeing where they're at in June and slowing down from there. But for the next foreseeable future, they're still planning on raising rates. Inflation is more scary than the illiquidity of the banks.
Gotcha.
I think in the Fed's mindset. Whether that's supposed to be that way or whether that's fact, I don't know. But really, I think the Fed has a goal of getting in our target overall inflation at 2%. They're going to do everything that they can.
What were we at the last set of reports?
6. Yeah, so we went from 6.4 to 6. But the problem is, the reason the Fed raised most recently here, yesterday, is mostly because our housing actually, so the new housing or people getting under contract was up 14.3% in the month of February, which we all know in the real estate world, what happens in the real estate world pushes the rest of the economy.
Right.
So that unfortunately was a driver that they were concerned that inflation isn't put to bed yet when we have a 14.3% increase in new home sales.
Yeah, which is debatable how
Correct, how you
accurate
skew
that
the numbers.
information
Right.
is, because I know at least in our world we had a spurt of activity, but now it's all, correct me if I'm wrong, your applications are down in the last couple of weeks or staying pretty steady?
Staying pretty steady,
Okay.
yeah, for sure. February they were down, but no, March we're cranking actually. So that's where the consumer sentiment is always trailing behind, right?
Well, I think what we have noticed since the news came out with the banking issues is we've noticed that we'll call them normal realm of first-time home buyers to traditional, residential purchases has remained pretty solid.
Right.
But all the peripheral purchases, your land deals, your high-end, luxury markets, or the different everything outside of that regular real estate market has all of a sudden had the brakes put on again, because everybody's like, "What is going on?" A lot of those people do have much more than $250,000 in assets in different banks.
You may want to explain why $250,000 is kind of the key dollar amount as well. So,
Well,
For
so
those that don't know.
FDIC, insurance, basically the federal government, correct me if I'm wrong,
Right.
but the federal government is going to insure your deposits as long as the bank is federally backed.
Correct.
Up to $250,000. Beyond that, so for example, people at Silicon Valley Bank who
Correct.
had $1 million on deposit,
Right.
they are at risk for $750,000 when the Fed sees the bank.
Right, correct.
So-
and that's why the regional banks run into issues is majority of their people are high net worth individuals.
Yeah.
So a lot of those are uninsured deposits. So when you have people that are in that peripheral, as you put it, that are going for, higher end transactions, land deals, things like that, they are potentially concerned that their uninsured deposits, are going to go away and they lose that liquidity if the bank fails.
Yeah, and to put it in perspective, the Silicon Valley Bank was one of the top 2 or 3 lenders in the whole wine space,
Correct,
vineyard
right.
winery space,
Correct,
if not
right.
the number 1 lender in that whole space. And that gives you an idea. A lot of Napa, a lot of areas like that
Right,
had
correct.
heavily invested into
Correct,
that bank.
right.
And of course, many of those $1 million deposits, just the beginning for many of those people.
Right. Yeah. Well, luckily, people don't realize that the government did come back and say that they were going to make everybody whole.
Yeah.
Right. So they did say that they were going to let the banks fail, but they were going to make the individuals themselves whole. That news came out a little bit too late in the case.
No one is hearing about it.
Correct,
Yeah.
right. So, unfortunately, Janet Yellen hit the headlines and she said, this is a banking problem, we're really not going to do anything. And then literally that weekend, Saturday and Sunday, after she made those comments, our current administration was going up and cleaning up behind it, saying, no, hold on. We're going to make sure that nobody loses their money. The banks may have to change or do whatever. But the consumer sentiment prior to that was they thought they were losing their money if it wasn't FDIC insured.
So the long and the short of it is banks are a business.
Correct.
They're making money. They're having to meet demand,
Correct.
From their clients,
Right.
us.
Yep.
And as a result of the last few years of extremely low rates.
Right.
I mean, this really comes back to this dramatic shift of inflation going up,
Right.
rates going up,
Correct.
and the banks struggling to fix their cash flow problems.
Correct.
It's all
Right.
a cash flow
Yeah,
challenge.
it's a cash flow issue, sure.
Yeah.
Which, I mean, if you could put it in perspective, what is happening during 2020, 2021, and even 2022, the Fed was literally printing money as fast as it possibly could. So everybody felt like they had some money in their pocket, and even especially the banks that were getting, funds on PPP loans or PPE loans and all of that. What happens?
Even like People's Bank, I understand, doubled their deposits from 2020 to
Correct.
today. Like
Right.
they went from 500 million to almost $1 billion.
Right.
And they're a fairly small
Correct.
local
Right.
bank.
Correct. Yeah.
But that's doubling in 3 years.
Right. And so what Jerome Powell came out, and a lot of people didn't hear this comment that he made, but he associated with, we are literally using a vacuum cleaner to suck up all the excess liquidity that is in the marketplace. Like if you go back.
So unpack that further. What is that?
Yeah.
What are they trying to accomplish with that?
So again, the ultimate goal is to squelch inflation, right?
Gotcha.
So as money is liquid and as, everybody has a little bit of money in their pocket, literally cash is everywhere, right? People were looking, that's why crypto hit the heights it did. People literally had so much money above and beyond their own personal requirements that they had money to put into GameStop through Robinhood and all these other, right? We're talking individuals that probably had no business investing, but they had surplus cash and capital as a society.
We had some clients buy property that you would have never pegged them to have $1 million in their pocket.
Right.
Coming from crypto.
Right,
Like it was the
correct, yeah,
craziest,
definitely.
craziest thing.
Right, which kudos to them, congratulations, but there was just so much surplus and people weren't worrying about surviving. They were worrying about where they were going to put their money or investing, that it became a little bit volatile. But what literally the Fed is trying to do is all that cash that was out there that was surplus is going away, right? They're limiting the amount of funds that people can get, all of that, to be able to try to shrink that environment down to, again, get the inflation back down to 2%.
Gotcha. So, an opinion question.
Okay.
Everybody has their own opinion.
Yeah, right, for sure.
Can't hold it against you.
Yeah.
Is it unrealistic for the Fed to be targeting 2% right now in your mind? How realistic is it for them to get there?
At the expense of the economy, I
That's
don't
my
think it's
question.
worth it, right? So at the expense of the economy, however they're going to do that, right? At the expense of the economy, whether everybody feels pain or not. I think we've passed the point where this is going to be a quote unquote soft landing. You know, they go in percentages. So we have a 66% chance of being a soft landing, meaning that it disrupts everybody's life, but marginally, right? We're not going to have a recession, right? We're not going to go into that. That's considered a soft landing. And then it keeps dwindling. So right now, I think we're at like a 30% chance likelihood of not going into recession and only having a soft landing. And
So how do they define recession? Because many people are saying we're in a recession right now.
we have been since June of last year.
Correct.
In the traditional term of 2 negative GDP quarters back to back, right? We are in it under a traditional term. However, everybody's changing the meaning of the term. You and I feel that we're in a recession.
Sure.
I mean, as our family expenses grow and as, you know, the marketplace and you go buy groceries or eggs, for goodness sakes, you know, right? The cost of eggs and all of those
20
things.
chickens at home.
Right.
20 chickens.
Well done. So at that point, I mean, so me personally, I don't think we're going to get it to a 2%, but I think at some point, once we get close enough that we're not worried about this thing going uncontrolled higher again,
Well, help me
then
understand.
at that point, I think we're fine.
I mean, correct me if I'm wrong, but historic inflation is 3.5%.
Correct, right.
So why the 2?
Yeah, so it's like catching a falling knife. I think they have to, right? So you're going to pass it on the way. You're going to pass it on the way to try to get it. You and I talk about the pendulum swing all the time.
Yeah.
You can't stop a pendulum in its mid-swing. They're going to do their best, but if they try to target 3 or whatever it is, it's going to dip lower and then kind of rebound back.
Gotcha.
Just by the rise and fall. Because you can't peg it. You know, it's like steering a boat or driving a boat. I don't know if you've done that.
Oh, yeah.
But you have to actually make your decision well before you need to get where you're at on a boat. So if you're docking a boat, you let off the throttle back there to hit the dock in front of you, right?
Well, I think that
Or
maybe
you
the
reverse.
clearer analogy might be thinking like trying to shift an aircraft carrier.
Right.
Like you start to put input to pressure to move that boat
Right.
miles before you ever see any kind of movement. And
Most
that's how
certainly.
inflation is. That's how the real estate market is 100%
right,
as
yeah.
well. Like you get a ton of pressure, downward pressure before prices ever change.
Or do what
You
they
get a
do, right.
ton of pressure before inflation ever gets
Correct,
there.
right.
When you get there,
Yeah,
well, you got to reapply the opposite
correct.
pressure to it to even
counteract
think about
it.
it, and you're going
Right.
to go for many more miles
Correct.
before you change
Yeah.
direction. I hope that
Yeah, no,
picture
that
makes
that
sense.
does. And so, you know, a lot of the commentary from the Fed has been we have to look at this or revisit every 3 months because we may pass where we're going, and we know that we are, but we're trying to project ahead 3 months.
Well, it's a guessing game for when you let off
is.
of the pressure, and when
Correct.
you come, it's how close can you get to that target as you come back to normal.
And so that's why I go back to now it's a 30% chance likelihood of not.
So we're
you
still
know,
continuing to drop, which is, I guess, in theory, upping our chances of it being a rockier landing.
Correct. Yes. Right. As we do it, if let's say right now was actually the perfect mixture, right, of financial mixture, we're not going to know until 60, 90 days from now.
So what, just quickly and from a high level,
Yeah.
the difference between a soft landing and what do they even define the
Right,
other landing?
correct,
'Cause
yeah, so we don't-
we use the term crash, but I don't think that's an appropriate term.
Right, yeah, I don't think so at all. So a soft landing means that there's not going to be a lot of negative impacts felt across the board and going into a full recession, right?
Okay.
So a soft landing, again, creates enough consumer pain or creates enough to where we change our habits and we don't go. Inflation does not increase, but it slowly kind of declines as opposed to, the mortgage meltdown, the dot-com bubbles, the things like that. Those are considered, high volatility things. They're trying to avoid that.
Gotcha. So banking, as we started the first series of conversation, that's part of this soft landing will be these kind of issues in their minds.
Yeah.
Like in the powers that be.
Correct. So quantitative easing or something like that, where the government actually goes in and starts buying privatized things. So quantitative easing really started out during 2008, 9, and 10.
I have not heard that term in a long time.
Yeah, right. So we just have different forms of quantitative easing.
Yeah.
They just don't call it that anymore, right? So QE1, QE2, QE, right? So we were buying all of these mortgage-backed, or I'm sorry, not mortgage-backed, but we were buying treasuries, bonds, things like that. And then it transitioned to mortgage-backed securities. So So the government was just doing it in a different way. And part of the reason that the interest rates got as low as it did is they started buying mortgages up like nobody's business. So that was another way to be able to infiltrate liquidity into this. So they may not do it in a way that we know that they're doing it, but at some point we're going to probably see the government infiltrating funds into a certain sector that is going to help ease these different things. I don't think that they're going to leave us on an island.
Gotcha. All right. Testing.
Testing.
Okay.
Won't drop my water this time.
So we got a little bit better of a picture of what's going on in banking, what's causing the news headlines to trigger.
Yeah.
So switching gears from quantitative easing, because that gives me a little bit of heart palpitations because of thinking about 2008,
and
9,
the previous,
10.
right? Fair enough. Yep. Fair enough. I get it.
But switching, not so much that, policy
Right. Yeah.
questions. Anyway. Let's talk for a minute about, so your mortgage world, 24/7, 365 mortgages. What are you seeing right now as, say, some fallout from, or what are your customers, what are your customer sentiment? Where's consumer sentiment at right now?
Yeah.
You know, how is it affecting, or is it even affecting your world? Let's talk about that for a minute.
Yeah, I would say from my lending perspective, because the average home price is what, 464 right now? 446,
between 4 and 5,
right there. Yeah,
but depending on where you're at, 4 and 500.
Correct. So in that wheelhouse, looking at that and seeing that majority of my clients are, let's say, going to be 500,000 and lower, not a lot of difference. I think that when we talk about banking, when we talk about the financing and everything like that, it's usually going to be the more affluent people, like you had said before, that have a little bit more reservations about what's going to happen, long-term liquidity or where they're at. A lot of the buyers right now are either move-up buyers, right, to where they still can sell their house to be able to put cash down on the next.
Take advantage of the equity.
Right, take advantage of the equity, or quite a bit of first-time home buyers, quite honestly, where they're happy with $25,000, in assets to be able to then take and put into a purchase of a home. So that global news, or that really isn't getting to Main Street USA, in my opinion, or at least from the conversations that I'm having. So it hasn't slowed things down. A lot of people just inherently were hoping that when the banks were starting to fail, then the mortgage rates would go down to help kind of bolster.
I've heard that every day since.
Exactly. Same thing here. So when I call them and I say, hey, rates are actually up 1/8% than when we had talked last Thursday, that's the part that they can't really figure out.
Can't wrap their head around it.
So, I mean, that's the only part that applies to them. Other than that, they just want to get into their home and move forward.
And you said your applications have held fairly steady.
Yeah, so I did 32 in January. I mean, which is a pretty decent month for winter.
Absolutely.
So yeah.
So where does that fall compared to a year ago or 2 years ago, to put it in perspective?
So a year ago, probably on pace, maybe a little bit more than a year ago. Then 2 years ago, not even close. Like
Gotcha.
2 years ago, when we were in that 2020, 2021 kind of time frame, it was as fast as we could get them through and process.
Were you doing 50 and 60 applications?
Yeah, I mean, it would be common to get 3 or 4 a day,
Gotcha.
just coming through the door. So it was very common.
So can you describe a little bit kind of the sentiment from many of your clients right now, as far as, I know you said it doesn't necessarily affect them directly,
Right.
But what we hear in the news and what we're seeing does affect people.
Yeah, for sure.
I'm seeing it in a whole different way on the real estate transactional side versus the lending side. What are your conversations like right now? I mean, are they still fairly positive with people, or is it, are you having to talk people off the ledge all the time, or?
Well, so honestly, it's my, $150,000 to $200,000 buyer, and I hate kind of saying that specifically because I don't want to give anybody trepidation that's in that price point unnecessarily. But it's actually a lot of people that are in that certain price point that are more concerned about their financial future moving forward, and really taking on that $3,000 mortgage or something like that, that those are the individuals that I'm seeing more trepidation. Usually the two income households that are coming to get qualified for a mortgage and move forward, I think they feel that they're very stable in where they're at. Some of the older...
So that's a reflection on how they feel about their job security and
Correct,
economy.
right.
So
Yeah.
even though we have news headlines that aren't super positive,
Right, correct.
a lot of your clients feel pretty solid.
Yeah, feel pretty solid. So it's the individuals that are on contract basis, right? So I have a lot of clients that are on a contract where it gets renewed once a year or once every couple of years. I think those individuals are more concerned about the future than those that are just paycheck type individuals. And then of course the retirees, pulling out of 401ks and whatever to be able to offset their income or for down payment. There is a little bit of trepidation in that, just of unknown.
There's always trepidation in that
There
for that
is,
group.
right, for sure. Yeah. How long can my money last, right, is the
Not
big
long
question.
enough typically.
Yeah, right. Fair enough. So I mean, that becomes, but overall, to answer your question more thoroughly, I feel that there probably should be a more negative outcome in the conversations that I have than are actually happening. It's more of people.
So in other words,
wanting,
the inputs from what we're hearing or seeing or reading in statistical are potentially a little bit more negative than the actual sentiment.
correct.
Of
Yeah,
most people.
on the street. Yeah, for
I
sure.
think that's interesting because we're definitely seeing some of the same thing. But we'll go into the real estate side in a minute. So switching gears from the sentiment of the consumer, your clients, your customers.
Right.
What about on the mortgage side at all? Has this had any impact other than rates on the ability for someone to get a loan? Is there new regulation hitting? Is there tighter regulation? Is there anything?
Not in the residential side. So on the commercial side, for sure. Talking with commercial lenders and even had a chat with one the other day that their loan to values, right? So they're requiring 50% loan to value right now, especially if it's not a super strong transaction. So that's a lot of cash that you need to come in with to show that you're fortified. But from the residential side of it, I don't think that we're going to see a lot of places shut down. I think we're going to see absorbing of banks. So banks that can't do it or banks can't. There was actually one here recently, Homebridge Bank got bought out by CMG, which CMG is a larger direct lender, but rather than Homebridge closing its doors, CMG just acquired it, right, and kept the lights on, did everything they need to.
There's going to be a lot of capital market opportunities.
Yeah, we're going to see a lot of acquisitions, in my opinion. People that mismanaged cash, and as you know, 2020 and 2021, there was more liquidity for lenders. I mean, money was coming in hand over fist. Let's take a Loan Depot, for example. I think they had a $533 billion surplus last quarter of 2022, and they ran negative last quarter of 2021, and they ran negative almost all of 2022. They had a $173 billion loss.
So in layman's terms?
They have more people on staff and a bigger business than their current income can handle.
Got it.
So we'll see those people.
So literally their negative cash flow by
$73 billion.
Whew.
Yeah.
That's a little hard to recover from.
Yeah. Well, it's nice when you made 500 and some odd the year before.
Correct. You can carry it, but you can't keep doing that.
You can't do it forever. Correct.
Gotcha. Is that kind of normal right now in the mortgage lending space, the direct lenders?
Yeah, so a lot of them are making transitions, large layoffs, things like that to be able to do it. But if they didn't act quick enough or they're not capitalizing appropriately, then at that point, they can either be acquired or potentially go down. We're going to see, it's hypothermic where, when you go through hypothermia, all of your blood rushes to the core and it goes, right? Your appendages are damned because your body doesn't care. It's trying to get. That's what's happening in the mortgage world right now. So is it going to end liquidity? Or are we not going to be able to fund loans, things like that?
So basically, let me restate it kind of another way in super simple terms. In 2021, part of 22, everybody and their brother who was a loan officer made a good living.
Yes.
Like there was no issues for the majority of the market.
Correct. Because of refinances or whatever, but yes.
Yeah, when you could say, hey, I can get you 2.5% to refinance. You want out of your 5% mortgage?
Exactly.
It wasn't a hard job.
Yeah.
So,
correct.
And then refinances all but evaporated.
Correct.
With except for some debt consolidation type
yeah,
deals
divorce,
or
things like that.
Yeah,
the
yeah.
normal stuff.
Yeah, so refinances have basically gone away, which was probably
A
20,
large component.
30% of the
No,
mortgage
I mean,
market, 50%.
So the online lenders in those places, it was 55-60% of their volume.
Oh, good night.
Yeah.
That's a risky business model.
Most certainly.
So that went away. So basically, we're having a purging or a cleansing of the mortgage business,
Correct,
for lack of
right.
a better term. The same thing's starting to happen in the real estate
real
side,
estate
just
side.
not quite as quickly or as abruptly.
Right.
I tell you what, it felt like for a while I was getting as many phone calls from mortgage brokers every week as I was from
Yeah.
potential buyers on my listings. It got a little crazy there for a little bit.
There was a meme that was going around for a while. Hey, rates are up high. You have time for lunch now?
Yeah, exactly. People I hadn't heard from.
Right, yeah.
And I don't know how long was all of a sudden.
Right.
Hey, how's it going? Well, guess what? I'm still pretty busy, so
Right,
it hasn't
yeah.
changed on my side. So anyway, so there's a cleansing of the market
Right.
on the business side, but it's not so much an impact on the consumer. If you want to get a loan today, it's not really any different than your payments higher due to rate.
None whatsoever.
Other than that.
And it hasn't come, you brought up a great point earlier, there hasn't been anything that's been implemented by Fannie Mae, Freddie Mac, FHA, that is a punitive issue or problem with clients. So for example, sometimes when there's a lack of liquidity or something happens in the mortgage world, then they push that over to the consumer and say, okay, well, we can't do this type of loan. You have to have this debt to income ratio. They shrink their model to be very safe. We're not seeing any of that at
Well,
this
frankly,
moment.
the conventional lending limits have continued to go up.
Correct,
not
they
down.
have. Right, yeah.
So on that space, I guess it kind of leads to another question. You know, because of Dodd-Frank and all the rules that came into place as far as
Right.
lending guidelines, and guidelines are still fairly strict.
Yeah, they are. I mean, yeah.
So do you think there's chances of like the foreclosure REO market starting to come back? Like, are we going to start seeing some of that in your opinion?
We will, not to the degree that we saw in 2011 and 12. There's not, just because so many people, can afford their home and do all that. So the reason I think that we're going to go through housing troubles and turmoil, not extensively, but just a little bit of a rightening of, or a righting of the ship, we're seeing the bank statement loans come out. We're seeing some of the alternate stated documentation loans come out. We're seeing everybody carrying a construction loan, right? Through several cycles now. That's the beginning of when that goes into a shift, is because people can't afford the cost of a home currently. So we have to create loan programs that allow them to be able to do that, which then creates its own self-fulfilling prophecy.
Sure. Especially
So-
in the market right now where values are dropping.
Right, correct. Well,
so-
everywhere but Southern Oregon, for the most part. We are not near as much as everybody else.
The data's
Yeah.
starting to become more clear.
Right, yeah.
It's starting to become more clear.
So
in other words, so it's those peripheral markets around. Well, so you have all the secondary market, the Fannie Mae, Freddie Mac, VA,
Right.
all
Right.
that market.
Yep.
You're saying pretty much everything on the outside of that market is what you see more at risk
Correct.
than those traditional
Right.
residential loans.
Which is a very small component of it.
Right.
I
So
mean,
that's what, 1 in 20 transactions.
I don't know the stats on that, but yeah, probably even less than that.
Yeah.
Quite honestly.
Well, 1 in 2 in my world, but
Right. Correct. Yes. Fair enough.
so I guess to recap, mortgage market's going through a cleansing.
Correct.
Or the business side of
The
it.
business, right?
If you want to get a loan, not a big deal. Still, other than the obvious change in payment.
Correct.
What else? What do you see on the horizon? Staying on the residential side, do you anticipate some additional tightening? Like, is now, with rates continuing to go up a little bit more, do you think there's going to be additional regulation as we start to see some of those foreclosures or different things?
So
Or is
one
that
of
too hard a question to answer?
No, not at all. I don't think we're going to see a lot of foreclosures happening across the board right now. Not just because of regulations or anything like that. I feel that people have equity in their home that they're going to wind up short selling the property before they foreclose. So there's just still, because of the value increase from 2020 till now, majority of people still have equity in their home that they, even if they have to get rid of it, they can do it and either, get out with just enough money to go to their next adventure, or even walk away with more money than that. So until that value goes down quite a bit, then at that point, people then are forced to foreclose or do whatever. But right now, there's still too much equity in the average consumer's home to not go that route. So that's what's going to keep us out of that.
That makes sense. So let's switch gears from the residential, and I know you don't do commercial loans, but we've had our fair share of experience dealing with clients in that world. What's going on the commercial side that's so different from the residential side? Because it obviously, you alluded to it earlier, that there's a major difference between how commercial lenders are looking at risk right now versus the backing of Fannie Mae, Freddie Mac.
Correct, yeah, because it's their own money that's out on the street. So Fannie Mae and Freddie Mac, as you bring it up, if we as a lender want to eventually sell that loan, we retain majority of our loans, but if we want to sell it to Fannie Mae and Freddie Mac, we have a buyer. Right. We can take that residential loan and we can get it off our books, gain liquidity, and go from there. Commercial banks don't have that as a safety valve. They are retaining that loan. So if that loan goes upside down, backwards, anything like that, they're the ones that are actually taking the loss on their balance sheet directly, which you have a smaller regional bank. You have several of those. You now have lost your income stream. You've created those issues. So having a low loan to value, having somebody bring in 50% of the purchase price in cash, or making sure that that buyer has a lot of reserves, is going to increase the likelihood that that loan is going to successfully pay off through the duration. Where I am concerned about the commercial world is the residential world allows for 15 and 30-year mortgages and fixed rate mortgages. The commercial world does not. So we talked before, I mean, to take it full circle, a lot of people that feel wealthy right now or are wealthy right now, as their businesses start to slow down, as things decline, and their adjustable rate mortgage on their commercial property becomes due, there's going to be a big issue with refinancing those mortgages.
Huge.
Right, or sorry, those commercial loans.
Yeah.
So that becomes more my concern. I'm not worried today, and I don't think banks are probably as worried as they should be today, but worrying 3 and 5 years because that's all that they were willing to do the terms, or a 7 and a 10 in some cases. What's going to happen in that environment when those people can't refinance those properties?
Well, and to give you like a picture, you know, when a lot of our, say, 5-year adjustable rates,
Right.
if you locked a 5-year in 2020, 21, like there's a good chance your rate was like 3%.
Correct.
Now there's going to be a cap on how much they can adjust, but you still might be going to 5%.
You may be going to 7, 8%.
You may be.
Right.
So if you're comfortable in 2020 with all that cash flying around at 3%,
Right.
fast forward to today with contraction for multiple quarters in a row in the economy, say your income dropped, like in our case, you know, in the real estate sales side dropped a fair amount.
Correct, right.
Like all of a sudden, okay, I'm fine, not a big deal.
Right.
But if I had a adjustment coming that, you know, potentially increased my debt service by 30%.
Correct.
Like you compound a 30% loss in income with a 30% increase in debt, and it starts to become a pretty significant impact on those. I am much more worried about the commercial side. I'm much more worried about the ag space than I am about residential mortgages. I think that's what I'm seeing. We are starting to see, and this I think is half more industry related than it is necessarily lending related, but in the ag space, especially with cannabis and hemp, those are the properties we are seeing come up as foreclosures already, or we're seeing them go in fire sale type situations where we had hard money loans with balloons coming due in a year, 2 years, whether it's from the seller or from some private individual. We got a backlog of those beginning to come up. I think Kellerman's pretty busy right now lining up to send some foreclosure notices out. I think there's quite a few of them brewing. But anyway, long story short.
And is that really quick, is it translating to value for a buyer that wants to go and buy those properties now?
So what we've seen, and this is a little bit hard to decipher in this space because we do have drought issues as well in the ag space. It's also pushing values of irrigated land down. So I can't say it's only a lending or a market related pricing adjustment, but there has been up to a 30-40% decrease in value of irrigated farmland, and that is a provable statistic. There's enough sales to say that we went
this is now a trend.
We went from potentially 15 to 20,000 per acre in irrigated farm ground to legitimately we have multiple like 10, 11, even $9,000. I have 2 listings right now at $9,000 an acre in the active market that are not selling. So we have legitimately seen 30-40% decline. But I can't attribute all of that to a market change. I have to attribute a lot of that to drought.
Gotcha.
So there's two pieces to that. But what we have seen, it's a market that you and I, both follow, is income properties.
Right,
When you
correct.
get, it still boggles my mind what people are paying for duplexes, triplexes,
Understood.
fourplexes,
Right.
because most of those are cash,
Right.
related purchases. The debt service makes no sense.
Right.
But on the multifamily, completely changed when you get over, 4 units.
Correct, right.
Like that market is also adjusting based on cash flow
Most
as
certainly.
well, much more significantly than residential.
Right. Oh,
So-
I would agree, most certainly.
Like the luxury market's adjusting because second homes are so much more expensive.
Right.
The income property market is adjusting. The raw land market
Right.
is definitely adjusting. We just have this behemoth residential market right in the middle
Correct,
that's
right.
hardly moving.
Correct.
I mean, it's coming down some.
Right.
But these peripheral markets, which make
Right.
up a lot of the real estate industry,
Correct.
are
Those are being
adjusting
impacted.
quite a bit.
Yep.
So, and I think that's hard for people to wrap their head around, where it's like, well, my house is still $500,000 for a postage stamp in East Medford.
Right, yeah.
Like 1,300 square feet, and
Yeah.
Mahar, in one of the Mahar homes is still
Right.
selling for $500,000 for a new house, which still boggles my mind.
Right.
But that same price point in a piece of land may have been 500,000, now 300,000,
Right.
depending on what it is. But going back to like in the mortgage world or in that side, just moving forward, can't hold you to this.
Right.
Just gut level.
Yep.
Forecast. Like, how do you see things continuing to play out? Like, I would describe the residential market right now as a super soft landing,
Right. Yeah.
compared to other places.
I mean, 12 to 13%.
still on the same page?
Kind of, yeah. So I would say I'm still relatively, I'm still very optimistic about lending in the mortgage world and what's going to happen for the rest of the year, because I've done these cycles before, so this is not new to me, right? So this is what I've been talking about.
So you got in the business, what, 2000?
2001, 2002,
Yeah.
right
So
around
you-
there. So, I mean, taking a look at it, I don't think the interest rates are going to hit as low as people are thinking in the time frames that they are.
Right.
I've been pretty fundamental on that. Everybody was saying that, by start of spring, we were supposed to be in the low fives, and then some people were even saying 4.5. And really,
So spring just hit yesterday, the day before. What are we at today?
We're at 6.44, with,
Gotcha.
right around there. So
And that's straight, no points?
no points. Yeah. So that's the national average.
Okay.
Right. So I've held steadfast that I think we're going to see this, where I think personally rates are going to end up are probably the high 5% range. That's really where we had the most consumer confidence jump back in, right? Beginning of February, all of that. And then it still is enough liquidity for everybody to not go crazy with, right? So I think that's where we're going to balance out. But I'm, advising all of my clients that, like, hey, we may be 4 and 5 years out before the rates really drop. Like, you need to be comfortable with where we're at now.
So what are the chances
lot
they
of-
never drop? Or maybe not in the next 10 years, that they never come below 5?
Well, I don't know if we look at the early 2000s. I mean, that's really kind of what happened. My first mortgage in 1999 was a 6.75% interest rate, and that was a fantastic rate because we were coming off of 9% in the late 90s, early 2000s. So, I think it may take a long time to get back, to, let's say, below 5%, but it may be a couple years and without market manipulation. So that's what I'm going to say. The hardest part for me to answer that question, where I think it's going to go, and personally, is because they're going to manipulate the market just like they've always done. So where I think it should go, right, it makes no difference, because Jerome Powell could come out tomorrow because he got pressure from somewhere else and says, hey, we're going to do a reduction of 50 basis points on interest rate out of nowhere, right? But I don't think we're going to go below 5% in the near future.
Yeah, I think what a lot of people, we got so used to these low rates, we forget what precipitated those low rates.
Correct, right.
I mean, maybe the greatest real estate shift ever experienced, and
Correct.
hopefully ever to be experienced.
Right, yep.
Precipitated years and years of low rates. It came out of total economic tragedy that we
Right.
got used to
Right.
these really low rates. And
Yeah.
the reality is, healthier in the overall money market
Right.
would be if they were at 5 or 6%.
Correct, most certainly.
That would
yeah.
be healthier.
Well, the reason we
Not
were
for me when I want to buy my next
Right.
house, but
right. Well, again, going back to the mortgage-backed securities and the government purchasing them, that's why mortgage rates were so low. People didn't understand the economics behind it. That's why rates were so low, is because nobody wanted to buy them. It was pretty much just the government was buying all the mortgages, so you just kept lowering the interest rate.
Yeah.
That wasn't a healthy economy, nor was it a realistic economy. But the problem is it's too close in the rearview mirror for people to say, okay, I'm okay with the 6%.
well, we had 10 years
Right.
of below 5%,
Right.
basically.
Yeah.
I mean, we had 10 plus years,
Right.
and at some points 2.5. Like who does
Right.
that? But
Right.
anyway, we did.
Yeah.
So I think all the old timers say, well, whack when it was this rate or that rate.
Right.
You know, I hear that a lot. But the reality is we're back to
Correct.
normal.
Right. Yeah. We're back to that good old rate.
Yeah.
Right.
Yeah.
Yeah. So I just encourage people to be okay with it. At some point, we're going to see the housing adjust to where this becomes a little bit normalized. But there may be mortgage loan programs that come out and do a 40-year, just like vehicles over the years. You could pick up a beautiful truck, 5 years ago for $30,000, right?
Yeah. That's a sad thing
Now,
to think about.
right? But now that just keeps going and going, because now we can do 7-year, 8-year car payments, right? So the mortgage world at some point is going to do that as well. So now that's why I don't think housing price is going to drop a lot. It's because if we go into a 40-year mortgage, average American doesn't care about the cost of it. They care about what it means to them on a monthly basis. So if we can go to a 40-year mortgage, right now at this point, $400,000 doesn't look so bad anymore.
Sure.
Now that's that new benchmark. That's that new price point, right?
That's an interesting concept. I haven't thought about making 40 or 45-year mortgages. I know that they exist in the commercial space.
Right. Yeah.
That'd be interesting. So I think it's interesting. Let's shift gears a little to like demand
Okay.
in the market, and this is going to become a little bit more of a real estate kind of conversation. You've said that your applications are similar to last year, but half of what they were the year before.
Correct. Yeah.
And I think that's a good way to describe the market right now.
Yeah, for sure.
It's not a bad market, but it's half of what it was in
Correct,
many ways,
right.
demand-wise. I'm not
Demand-wise.
speaking about pricing.
Value,
So
right.
just to give you a couple of just hard numbers to chew on the value side, to kind of put everyone's minds kind of at ease if you're thinking about selling. For example, in Jackson County, and this is pretty similar. Actually, Josephine County hasn't come down quite as much, believe it or
Right,
not.
correct.
Jackson has come down a little bit more.
Yep.
But we've only seen about a 4% decline in residential pricing. When I say residential, I mean urban residential houses in
correct.
town. We've seen about a 4% average decline for year over year. And that is still up 41% from 2018. 41%.
Right. Mind-boggling.
And in the rural market, so everything outside of the city limits, we've seen about a 6% decline from last year, but that is still 30% up from
Right.
2018. But what's happening and why this market is kind of being propped up is an inventory conversation. So we are overall in Jackson County, there's about a 22% increase in overall inventory, which, to put that in perspective, that sounds like a lot, but not when inventory was like 5% of normal or
correct,
whatever it was for that period of time. So it's only a little bit of an increase. So though we have a lot less buyers in the marketplace,
Right.
we have still a relative limited amount of inventory. So it's still that supply and demand model.
right.
Supply is still low, demand is lower, but it's making a little bit more of a balanced market where people are still selling their house in less than 2 months
Right,
on
correct.
average,
Yep.
like kind of across the board.
Yep.
The rural market, I will say, has gone up about 40% in inventory, though. Not so that it's the in-town market that is keeping inventory down. The rural market, the luxury market, and the land market are all
Increasing.
outpacing the residential market as far as inventory goes. Try to buy a duplex right now. We're listing a duplex next week. I could not believe, but there's virtually nothing available of any quality for 2 to 3 units. But you know why? Everybody's pulling their cash out of the bank and they're going and buying.
Exactly,
they're going
right.
buying whatever they can. I mean, that's the reality of right now.
Right,
People are
correct.
like, "Oh, I'll take $3,000 a month in income on my 500,000
Correct.
that I can guarantee I can go kick it
And
if
I
it
can
goes
go
down in
see it.
value.
Exactly,
Yeah,
right.
I can at least I can go kick it.
Right, yeah.
That's what I've always joked. At least I can go be mad at my dirt and go visit it.
Oh, that's
But-
hilarious.
So it's a story of demand, and what I was gonna, where I want to go with that, it's still, we still have a lot of people transacting.
For sure.
The peripheral markets is where I'm going with that.
Yeah.
Residential market is still pretty robust.
Yep.
If you need to sell a house right now, there's buyers for it.
Correct.
If you need to buy, you're not going to be up against 10 other people.
Right.
You're going to be in a position where generally you can negotiate a little bit with the seller now, not across the board. We still see an occasional multiple offer.
Right.
Average list of sales prices are still hovering 98%, somewhere in that range.
97.4,
But
yep.
what doesn't show up in that is all the credits.